All right, I'm going to do a quick market wrap. I don't suspect that things will change a whole lot between now and the close, so this will serve as a weekend market wrap. Um, I've been seeing a lot of people trying to pick a top to this rally. Again, it seems like almost everyone is assuming this is a bear market and this is a bear market rally, and the odds are extremely high that they are going to be wrong. In order to have an extended bear market, the economy has to be rolling over into recession, and there is virtually no chance that we are entering recession anytime in the near future. In order for a recession to start, the middle class consumer spending, discretionary spending has to collapse. And historically, the only way that ever happens is um, because of a huge spike in inflation, namely the price of oil. Now, if oil goes up, as long as it goes up slowly in a controlled manner, people can adapt to that, economies can adapt to that, and it's not a huge concern. The problem occurs if the price of oil rises very rapidly by a very large percent. I typically use 100% within a year or less. When that happens, it almost invariably is just too much for the economy to assimilate, and then just costs too much for middle class um, people to fill up their tank, their gas can or their gas tank every week. The price of energy is incorporated into food, and so just the basic necessities of life start to eat up too much of their discretionary spending. So um, spending collapses, people start to lose their job, and that's what causes a recession. And clearly, with oil at just a little over $50, there's no risk of that happening. So there's almost zero risk of a recession anytime in the near future. Without a recession, there's no way for this to turn into an extended um, multi-month bear market. So let me widen the chart here, and I'll show you what happened. All right. So I mean it's pretty obvious on this chart. The only thing that happened is we had a regression to the mean event. They typically happen about every 4 years. This one occurred slightly earlier. I'm not really sure why, but it did. So you can see when we're in a secular long-term bull market, these 4-year cycle lows tend to come back down and tag the 200-week moving average. You can see that we did that as we were coming out of the bottom here, and we get the first test of that average, and then we break through, and then we test it from the upside. Holds, the bull market really starts to gain traction. We break out above the 2007 highs. Price gets stretched a little bit above the um, average here. The market starts to get worried about the Fed raising rates. We get our first um, regression to the mean correction, the first 4-year cycle low, actually the second, I guess. This was the first one, comes down, tests the 200-week moving average. Then Trump takes office. He puts into place tax cuts, um, policies very beneficial for business. We get a very strong trending move higher as we break out of this consolidation box. And then we just got stretched a little too far above the moving average. The market decided to latch on to the rate hikes and the trade war as a reason to um, correct, pull back down, and test this average. You can see we're holding well above that. So very little chance this is going to turn into a more extended multi-month or year, 2-year bear market. This was just a regression to the mean event, same thing that happened here, same thing that happened here. All right, this is the NASDAQ composite. You can see we're holding above 7,000 here. We've rallied very aggressively off this bottom, broken back above 7,000, and we're holding above it. All right, moving on to the daily charts, you can see price has broken above the 50-day moving average. It's tested it a couple times. It's holding. We've broken the intermediate trend line. We're holding above that. I've tried to warn people that it's just too early in this intermediate cycle to be trying to pick a top. I've seen people do this for 20 years. When we get these intermediate bottoms, they've become conditioned to expect lower prices. They can't flip the switch and then move on to trading strategies that work during the advancing phase of the intermediate cycle. So they get caught trying to pick a top, and let's face it, traders have been trying to pick a top since way back here, and they're still doing it. They're seeing whatever bearish pattern that they want to see to confirm their bias that this is going to top soon, and it's just sentiment. We hit sentiment extremes down here that in some cases were worse than the 2009 low, and it's too early to try and pick a top. We've got to clear those sentiment extremes, and we aren't really even close to doing that yet. So I would say, and let me move this over to the S&P. All right, so moving over to the S&P, I expect we're going to at least test this 2,800 level before this intermediate cycle tops. And I'm going to reiterate again that this will probably just boil down to whether or not we get a trade deal with China. I think we're going to test this level either way. If we get a trade deal with China, we're going to blast through this. We're going to come up. We're going to test these highs, and then we're going to break out to new highs. And the second phase of the bull market will be on its way. We still have probably 10, 15 years left to go. On the other hand, if by the time we get to this 2,800 level, if we still don't have a trade deal in writing, then there's probably a good chance that we're going to come back down and retest these lows. But until we reach this level, it's just too early to be trying to pick a top. All right, moving on to oil. This is where the real opportunity was. We entered positions in oil, leveraged positions in oil right here. We profited over 35% in like less than 3 weeks from this, and I've seen a lot of perma bears want me to find a reason to say that this is a bear market and to go short, and I'm just the fundamentals just aren't there for that, and so I'm losing a lot of perma bear subscribers, and all they've done was miss the best trade of the year so far, and I don't think this is done. It's taken or it took almost 3 weeks for this I guess probably what's going to turn out to be a left shoulder of what I think is a inverse head and shoulders pattern in play. We're about 2 weeks into this, so I would guess we're probably going to stay stuck in this choppy range for maybe another week, but maybe by the end of next week, I think we're going to break through this resistance level here at about 54.50, and this inverse head and shoulders pattern would target something up between the let's call it $62 to $65 range, and I think that's probably where we're headed during this first daily cycle in oil. So this has already been a tremendous trade that many perma bear biased people have missed, and I think there's still plenty of upside to this a trade in oil once we do finally break through this resistance here. Moving on to gold. I'm a little bit torn on this one. This looks like a daily cycle low to me, but we didn't break the daily cycle trend line, so I'm still a bit leery about trying to call this bottom, but um, I think we've got a nice cup and handle pattern in play on gold, so maybe this just turns out to be one of those times where we don't break the intermediate trend line, and maybe this is all we're going to get for a daily cycle low. Sometimes that can happen with these rounded bottoming patterns. You just you just don't cover all the bases on these daily cycle lows. So up here at the top, I kept warning people get off leverage, and we were due for a daily cycle decline. The the correction in the miners has been much steeper than gold, so that was very good advice in gold. So at this point, um, I guess you could possibly put your leverage back on and then just put a stop right underneath this level here at at about $20.20 on GDX. And if we come back down and break that, it just means that the daily cycle still has further to fall. But we are late in this daily cycle, so we're due. I just would have preferred to see gold break that trend line and complete that confirmation before trying to pick the bottom. But um, it it looks like there's a decent shot that we have completed the daily cycle low in gold, and it might be a good time now to go back to leverage uh, and then finally let's look at the dollar. All right, so again I was warning that the dollar was due for a bounce, and I said that the ECB would try very hard to weaken uh, the euro against the dollar and prop the dollar up, and obviously they did. But um, the natural forces in the market are going to fight that, and we really should this rally really should top without well, naturally it's never going to come back above here. It's just whether or not central banks can intervene and force the market to do what it's not really meant to do. But as of today, well, yesterday the dollar tagged the 50-day moving average, and it's turning back down again today. So that the natural forces are trying to push the dollar back down, and this daily cycle is trying to left translate. And if it does, then gold is going to have another leg up. Um, it's going to boil down to whether or not central banks can uh, force the currencies to do what they're not meant to do, and we're going to need a few days here to make sure. But my feeling is that they can try, but ultimately they are not going to succeed in keeping the dollar propped up. That it will ultimately it will come down and break below this daily cycle low and confirm that that the intermediate decline is not over, and it shouldn't be over until we come down and break this intermediate cycle low, as this cycle is potentially left translated. And when that happens, when we break this low, that will confirm that the 3-year cycle has left translated, and that I've been right, and the dollar's in a bear market, and we should have 6 to 8 years yet before this secular bear market in the dollar is done, and this is going to create inflation. So that's why I keep saying that we're entering an inflationary phase over the next decade, probably.